Today, we're going to take a look at municipal bonds here in the U.S. Budget squeezes that we're seeing in states and in cities across the country are only getting worse and only expected to continue to get that way. One example is Detroit. That city is preparing to sell $250 million worth of bonds, even as it warns investors of a possible bankruptcy filing. Here to talk about the various municipal bond auctions that are scheduled for this week and to give us his thoughts on the reality of the muni market right now is Brad Gewehr. He's head of fixed income research at UBS Wealth Management. Good morning to you, Brad. You know, heading into an environment where most expect taxes to only go up, tax-free paper would seem like it would be hot in demand. Yet, you hear about Detroit, you hear about other cities saying we're going to have more difficulty perhaps paying the bills right now, and that's got a lot of people concerned. What's the reality of the muni market?
Well, the reality is twofold. First, as you say, there is a very strong demand right now for tax-exempt paper. Several things driving that. We've got, as you say, higher tax rates. We've got a scarcity of supply because the Build America bond program has taken about 30% of the market, shifted it out of the tax-exempt world into the taxable world. So we're seeing less supply available. And what's happened is that at the very highest rating levels, at the AAA levels, we're seeing a very rich municipal market right now. However, we're also seeing very inexpensive bonds at the lower rating levels. So if you go down to the AA or the single A level, there's real value there. And I think part of that stems from a lot of the alarm that we're hearing in the market about credit, about municipal ability to repay. Our view is that those fears are greatly exaggerated at this point.
You were just mentioning the status that you would look at, the AA's or AAA ratings. You know there's a fair amount of skepticism about the accuracy of those ratings, and then you hear about the issues of states and cities being able to pay their bills once the stimulus checks stop coming, and with property prices being what they are right now. So how do you select the cities and states that are actually going to be able to prevent a default, avoid a default on their debt?
Well, I think, first of all, you have to look back, and you look back over the past 40 years, and municipal defaults are extremely rare, especially within the general obligation, the essential service utility, water, sewer, electric revenue bonds, dedicated tax bonds. Defaults are extremely rare. They're far less common in the municipal world than they are in the corporate world or in the sovereign world at any given rating category. So I think there is still a substantial amount of relative safety there. Investors do, though, have to be selective. I think one of the things that's changed, we've had this great rally in 2009, and we've recovered and then overshot in some ways the lost ground of late 2008 when the market collapsed. But really, we don't have the same market that we had before the crisis. Bond insurance is all but gone. We have one bond insurer left in effect. That's down to under 5% of the market of new issues. We used to have 50%. So investors don't have the same level of safety blankets and safety nets under their municipal bonds that they used to have.
Now, we know this week there are a number of issuances expected. California is supposed to be pricing a deal. We mentioned Detroit as well. So how do you sift through the nuggets here? Well,
I think, first of all, every investor in a different state has a different demand because of the state tax exemption. So California investors are going to look very carefully at this $2 billion California deal that's coming this week. Hopefully they will have enough information in the official statement to be able to sense where the state budget lies. Clearly, as you said at the outset, all of the states are going to struggle for another year or two, some more than others. And we are going to see a lag in the state fiscal recovery. But we don't expect the market to collapse. We don't expect municipal defaults to suddenly change the pattern of the last 40 years and enter into a crisis.